Could a new job or even a slight pay raise accidentally cost you your entire grocery budget? Or worse, could it land you in serious legal trouble? I know, it's a terrifying thought, right? But the reality is that misreporting your income to Wisconsin's food share program can lead to sudden benefit loss, massive bills asking you to repay benefits you've already spent, or in extreme cases of fraud, federal fines of up to $250,000 or even imprisonment. Correctly reporting your income isn't just some minor administrative hurdle. It's absolutely crucial. It's the literal foundation of keeping your household fed and secure. Well, take a deep breath because you are in exactly the right place. Welcome to This Explainer. I totally get that navigating state bureaucracy and understanding exactly when and how to report a change in your income can feel overwhelmingly confusing. It's like a giant puzzle. But today, we're going to break it all down. We'll give you a clear, stress-free guide to maintaining your benefits perfectly by the book in the state of Wisconsin. By the time we finish this explainer, you're going to have total confidence in handling your food share reporting. So here is our roadmap for today. We're going to quickly cover food share basics, the 130% FPL rule, step-by-step reporting, tools and resources, avoiding pitfalls, and wrap up with some real-life scenarios. Let's get into it. Section 1, Food Share and Income Changes. The basics. Okay, so Wisconsin's version of the federal SNAP program is called Food Share. To keep those benefits flowing to your Quest card, the state needs to know about your income so they can ensure you're getting the right level of assistance. But here's where so many folks make their first mistake, understanding what income actually means to the state. See, they calculate your eligibility based on your gross countable income. Look closely at this definition. Gross income means the money you make before taxes. Well, actually, it's before taxes, before union dues, health insurance premiums, the whole 9 yards. Any deductions taken out of your paycheck don't count here. It's absolutely vital to understand this. If you calculate your income based on the final amount that actually hits your bank account, your net pay, you'll be underreporting your income, and that can trigger a nasty overpayment penalty. Moving right along to Section 2, the golden rule, 130% FPL. Now, you might be thinking you've got to call the state the second you pick up an extra shift. Nope. For most food share households subject to simplified reporting rules, you are actually bound by a golden rule. You are only mandatorily required to report an income increase if your total monthly gross income crosses 130% of the federal poverty level for your specific family size. The state determines this exact dollar amount for your household at your most recent certification or renewal, and they print it directly on your enrollment letters. As long as your total gross household income stays below that specific 130% limit, you don't have to report minor fluctuations in your earnings until your next 6-month report or annual renewal. This rule is a real game changer. It saves you time and keeps your benefits completely stable. But what happens if you have a fantastic month and your income does cross that 130% threshold? That brings us to one incredibly important number, 10. If your income goes over your limit, you absolutely must report the change to your agency by the 10th day of the month following the month in which you received the money. So, let's say your gross income goes over the limit in August, you have until September 10th to report it. Mark your calendars, folks, because missing this deadline is for sure the fastest way to incur a penalty. All right, Section 3, Step-by-Step Reporting Process. Knowing the rules is great, but here's how to actually execute them flawlessly at home in 3 simple steps. First, calculate the gross income you actually received in the calendar month. Second, gather your verification documents. The state considers written documentary evidence as the gold standard. This usually means saving your last 30 days of pay stubs or having your employer fill out an employment verification of earnings form. They call it an EVFE. Finally, step 3, submit your report and your proof to your local agency. Now, there's a tiny bureaucratic quirk here that catches a lot of people off guard if they prefer to use paper forms. Wisconsin operates a centralized processing system, but it's divided geographically. If you're submitting the paper income change report form, the F16066, and you live in Milwaukee County, you've got to mail or fax it to Milwaukee Enrollment Services, or MILES. But if you live in literally any other county in Wisconsin, your paperwork must go to the Centralized Document Processing Unit, the CDPU, down in Janesville. Sending your private documents to the wrong P.O. box can delay the whole shebang, so always double-check that routing. Next up, Section 4, Helpful Tools and Resources. Thankfully, you do not have to navigate this system alone, and you definitely don't have to do it the hard way. You can choose the reporting channel that best fits your lifestyle. You can log into the Access website at access.wi.gov and just use the My Changes feature. Even better, you can download the My Access mobile app right to your smartphone. This app is incredibly powerful because it lets you securely snap pictures of your pay stubs and upload them directly to your case file. If you're someone who prefers speaking to a real human, you can call your local consortium call center, like the WKRP call center, or you can just stick to mailing or faxing the paper form. The big takeaway here: help is always available. If you ever feel stuck, if you can't figure out if a particular holiday bonus counts towards your gross income, or if your employer is dragging their feet on filling out your verification form, just call the phone number printed on your state notices. Your local economic support agency workers are literally there to help you navigate these exact scenarios. You can even swing by and visit them for in-person assistance during regular business hours. Section 5. Avoiding common reporting pitfalls. Avoiding common pitfalls is the difference between a smooth reporting experience and weeks of massive headaches. The absolute biggest trap I see: reporting anticipated income way too early. Listen carefully to this one. A reported change in income can only be counted against your limit after you actually receive the money. Getting a job offer is amazing, but do not report that income until you hold that first actual paycheck in your hand. Other major mistakes include ignoring requests for verification. If you don't provide the pay stubs, they will close your case. You also need to keep an eye out for unclear information letters. If the state cross-references tax data and finds a discrepancy, they'll send you one of these. Ignoring it is a guaranteed ticket to getting your benefits suspended. And finally, if you're subject to the work requirement, remember you still have to report if your hours drop below 80 hours a month. Okay, fun fact time. Here's a detail I absolutely love sharing. While the state is super strict about when you make too much money, you're not strictly required to report a sudden drop in income between your renewals. But here's the kicker. Proactively reporting a loss of hours, a job loss, or even sudden massive medical expenses is highly encouraged. Why? Because updating your case with a lower income could actually increase your monthly food share benefits. The system will generate a courtesy letter asking for proof, and if you provide it, boom, more money gets added to your Quest card. Let's bring it all home with Section 6, real-life reporting scenarios. Let's look at how all these rules and deadlines actually play out in the real world with two practical examples. Take a look at Ted in scenario A. Ted starts a new job on December 30th, but he doesn't get his first paycheck until January 17th. Because he physically received the funds in January, and that gross amount pushed his household over his 130% FPL limit, Ted is on the clock. He absolutely must report this by February 10th. Now, compare that to Joan in scenario B. Joan just nailed an interview and accepted a great job offer. She knows her hourly rate, but she hasn't worked a single shift or received a dime yet. Joan does not need to report this yet. She is completely safe to wait until her first actual payday to see if her gross income crosses the threshold. Now, real quick before we wrap up, I want to emphasize a professional disclaimer here. We've covered a ton of ground today, but please keep in mind that this explainer serves as a general guide based on Wisconsin's current policies. Laws, administrative regulations, and those exact federal poverty level dollar amounts, they change every single year. You should always check the exact dollar limits printed on the official letters sent to your specific household and verify your unique requirements directly with your local agency. And that brings us to the end of our journey through Wisconsin's food share reporting rules. So I've got to ask, are you prepared to take total control of your benefits and protect your household's food security? Don't wait until a simple misunderstanding costs you your groceries. I highly recommend you download the My Access app today, log in, and check your specific 130% reporting limit right now. Knowledge is power, folks, especially when it comes to navigating state systems. Thank you so much for joining me for this explainer. Be sure to follow our channel for more clear, empowering guides just like this one. Stay informed and stay secure.